Well, with interest rates at record lows in Australia and many other places in the world, it's risk on for investors in the hunt for yield. Howard Marks, the co-founder of investment giant Oaktree Capital, with almost $180 billion under management, is a little concerned about our appetite for risk. With so much uncertainty and volatility ahead, he says he wouldn't be surprised if negative yielding bonds end up being the future safe haven of choice. Steph Nash spoke to Mr. Marks at the recent Sohn Hearts and Minds conference in Sydney.
Howard Marks, lovely to have you here in Australia.
Thank you, Steph.
Huge investor day today. How do you see the market?
Well, the market is kind of in between. I mean, it's not a bubble, and it certainly hasn't crashed. You know, what I would say, four things. Number one, there are a lot of uncertainties in this world, most of them on the macro level as opposed to corporate. Usually when we have a lot of uncertainty, we have high prospective returns to compensate. Today we have the lowest prospective returns we've ever seen in many areas. High security prices, not bubbishly crazy, but on the high side of fair or the beginning of rich. And finally, we have a lot of what I call pro-risk behavior. People who don't want the low offered returns on safe instruments like cash, money market, treasuries, and bonds, moving up the risk curve to try to get the returns they want by engaging in riskier behavior, and that makes the overall market riskier.
Does that concern you at all?
Well, it is concerning, yes. You know, I would sum it up by saying that we're in a high-risk, low-return world. That's not a great formula. I think that the world of today is being shaped by optimism and not pessimism, by risk tolerance, not risk aversion. And when optimism and risk tolerance are in ascendancy, it makes the markets a somewhat risky place.
And so with interest rates so low, where should investors be putting their money? Where do you go for high yields during times like these?
Your premise is that you should go for high yields. You have to recognize that in a low return world, the only way to get high returns is by taking on risk. So your premise is not necessarily right. Not everybody should be trying to make high returns in a low return world. The prudent, safe, but unpleasant thing is to accept low returns in a low return world and enjoy your characteristic level of safety. If you want to make high returns in a low return world, you have to take risk. Most people are moving out to either private equity or private credit, or all the way out to high-tech investing. These things clearly have the potential to produce high returns if they work, but a substantial uncertainty about whether or not they'll work. That's what risk is all about.
I've read that you are skeptical as to whether a recession is really avoidable. You say economic stimulus might just delay the inevitable. Why is this?
Well, number one, I think that cycles are natural. You know, we have a trend line for let's say the country's growth, and we have periods when we grow faster than trend because of some optimistic decisions primarily, and then we have periods when we grow slower than trend because people turn pessimistic. And when we turn from excessively positive to excessively negative, as we invariably do, it often brings on something called a recession. And I think that process will always take place. I don't think that central banks create growth. I don't think they create business. All they do is they take business that would normally occur in the future and accelerate it to the present. But that leaves a hole where they took it from. And how are they going to fill that hole? And the answer is they can then take further out transactions and accelerate them to fill the hole. But can this process really go on forever? Can central banks really prevent recessions?
In a recent memo of yours, I read that negative yielding bonds might be attractive to some investors. Can you explain why?
Well, what I meant, Steph, was that you know, it's possible that people who are buying bonds which guarantee them losses over the full term are foolishly participating in a mass hysteria. But there are some reasonable reasons to buy those bonds. They don't appeal to me, But the people doing it aren't necessarily nuts. For example, if you see a bond that yields minus 0.5%, and you think that interest rates are going to go further down, then buying that bond will produce a profit if you're right in your expectations. So that's not irrational. Or you might think that the currency in which that bond is denominated is going to go your way, and that would be another reason to buy the bond and make a currency gain. So, as I say, not necessarily nuts, but you know, we've never seen negative rates before in our lifetime, and it's hard to say that we know exactly what to do about them.
And so just on interest rates, do you think low interest rates work to stimulate the economy?
Well, in general, they do. But if you've been lowering rates for, you know, rates have been coming down in the U.S. for 37 years, and can it work forever? And especially when you get into the close to zero or negative territory, you know, there's concern about what's called pushing on a string, which is a term that economists use. You put a string on the table, you push from the back, the front doesn't move. The question is, by continuing to cut rates, can you get people to spend money? Maybe not. One of the thoughts that I expressed in my memo on negative rates, which, by the way, I titled Mysterious because I find that they are, is that when the central banks turn interest rates negative, one possibility is that they send out a very pessimistic signal and scare people. And people say, number one, what's going on? It's scary. Number two, I don't have the income I used to have. That's scary. And so they say, I'm not going to spend money. I'm going to save more. And the savings rate in Europe, where they have negative rates, has been rising. So can negative rates get people to spend money? It's not completely clear.
And what about quantitative easing, central banks printing money to buy bonds and increase global money supply? Do you think that works?
Well, it worked great the first time. It worked a little less the second. In the States, QE2 worked a little less well. We'll see, I guess, pretty soon what happens with QE3. You know, I think that in Fed actions, there's a large psychological component, almost a shock component. And you know, when the Fed says, we're going to go out and buy X trillion of bonds, people say, oh my God, that means there's going to be more money in circulation, the economy will do better, we should spend and invest. The second time they do it, or the third time they do it, it may not have the same effect. We'll see. You know, this is not physics. This is, you know, it is not subject to these hard and fast laws. And when things are tried that haven't been tried before, or in amounts that haven't been done before, all we can say is we'll see.
And just lastly, Howard, the US election, the upcoming election, how do you see this impacting the economy?
I was here for the first Sohn conference in November of 16. It happened to be the US election day. And I got the results when I was here in Sydney. We were sure of two things that day. Number one, that Hillary Clinton would win, and number two, that if Trump won, the market would go down. So instead, Trump won, and the market went up. And what that shows me is we don't know what's going to happen, and we don't know how the market's going to react to what happens, and I still feel that way. We're a year away from the election. In several of the last elections, a year ahead, nobody thought that the person who actually became president would become president.
Howard Marks, thank you very much for your time.
It's a pleasure.